Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. Now, this past Monday, Tariff Day, a market participant sent me a mocked-up photo of a guy wearing a t-shirt that read, "I survived the global trade war investment-grade bear market of," wait for it, February 3rd, 2025, 6:30 a.m. to February 3rd, 2025, 10:30 a.m. Such is life under Trump 47. David Rosenberg of Rosenberg Research recapped Monday this way: tariffs on, tariffs off. Tariffs on, tariffs off. Welcome to the world of Trump. Total chaos. Nobody can forecast, nobody can plan. Now. 2 weeks in and Trump's flooding the zone. This one from David Ignatius at the Washington Post. Real estate developer in a China shop. Cute. Now, this week our three things are: 1. Tariff time. We'll provide some perspective on how to dimension this age-old risk. 2. Credit's iPhone moment. Two heavyweights tell us we're at an inflection point. And 3. Earnings checkup. We'll give an updated view of that which underpins just about every asset class in credit. All right, let's dig a bit deeper. Tariff time. Now, on Monday, as the aforementioned reference to the t-shirt suggests, we awakened to U.S. President Trump making good on his promise to make tariffs, or the prospects of said, a centerpiece of his economic policy framework. Markets were shocked at the breadth and magnitude of what was proposed. We now know Mexico, then Canada, made or reiterated promises to address border issues, earning a 30-day reprieve. China responded with some retaliatory tariffs of their own, filed a complaint with the WTO, and coincidentally launched an investigation into Google. And so it goes. Now, markets have rebounded as if it never happened, supporting the notion held by many that Trump, true to his transactional orientation, is using tariffs as a negotiating stick. Well, we're in this camp. Sort of. We do take Trump at his word that he will use the threat of tariffs as leverage to right whatever wrongs he sees. It might be a trade deficit. It might be insufficient defense spending. It might be border and drug control. In any event, we believe you should expect a constant stream of social media commentary and executive orders coming out of this White House related to tariffs. Now, we do believe this president cares about market reaction. By now, he should be well aware of what markets think of trade wars. He experienced that vividly and painfully in his first term. Levying and escalating tariffs against Chinese imports over the course of 2018 culminated in a powerful sell-off of risk in the fourth quarter when the S&P dove 19%, credit spreads gapped wider, and recession probabilities jumped. Eventually, the Fed had come to the rescue and cut rates in 2019. Now, that experience suggests to us that the president's latest deployment, significantly larger than what was executed in 2018, was signaling, putting countries and regions on notice that he is to be taken seriously. But it is that 2018 experience that limits the likelihood, in our opinion, of his most dramatic threat: universal tariffs. Two things we've learned and come to hold dear: investors despise inflation and trade wars. Tariffs introduce both. The rebound in risk prices this week suggests that the market believes Trump understands this and therefore is skeptical that he will follow through with material tariffs. Well, we are skeptical of that. We would expect more targeted tariffs on strategically important industries such as energy, industrial metals, autos, pharmaceuticals, semiconductors, critical minerals. And we expect a steady tariff skirmish with China. In addition, we expect he will make good on extending the reach of his tariffs to the EU, quote, pretty soon, unquote. That's his words. Now, one of our ground rules when looking at credit has always been that it is hard to model politics. Well, that's probably never been truer in developed markets than in the case of the current administration. So you could argue that the uncertainty, this policy uncertainty, and the willingness to accept at least some near-term pain argues for higher risk premia. That's lower equity multiples and wider credit spreads. All right, on to our second thing, credit's iPhone moment. So KKR is out this week with a comment that credit is going through its own iPhone moment. Okay, you've got my attention. The authors note that the iPhone, in seamlessly integrating music, communication, and web access into a single device, redefined the device, established a new paradigm. Agreed. And credit? Well, a bit of a leap, but KKR makes the point that credit markets are undergoing their own transformation from the old paradigm of siloed, fragmented products giving way to a new era of diversified income solutions across multi asset credit platforms. Now, the authors do acknowledge that the scale of innovation does not rival the groundbreaking transformation of the technology sector, but the broader point that credit market innovation is creating a better array of options and opportunities to construct a better performing credit portfolio is well taken. And we have long tied U.S. exceptionalism to the fact that the U.S. enjoys the world's best capital markets, markets that funnel capital to its most productive use better than any other system. The ever growing and evolving multi asset credit platforms KKR references include, of course, private credit, both high yield and investment grade, along with asset based markets and a reemergent private placement market. Now, these platforms, made available to a broader array of institutional investors, most notably insurance companies, as well as retail investors, continue to scale massively. Coincidentally, this week also had complimentary commentary from Mark Rowan, CEO of Apollo Global Management, who spoke of how traditional asset managers are going to, quote, reinvent their businesses spurred on by competitive forces, unquote. Specifically, Mr. Rowan pointed out that traditional asset managers are losing competitiveness due to what he sees as the incredible amount of indexation and correlation and data that exists in the market. He sees tie-ups of traditional asset managers with alternative asset managers via co-branded funds or separately managed accounts as a natural way for traditional asset managers to meet client demand for greater exposure to unlisted assets and, presumably, improved performance. All right, on to our third thing, earnings checkup. Well, we're just over the midpoint of earnings season with 58% of the S&P 500 reporting, and so far so good. Some 73% of companies reported year-on-year earnings gains, and if that holds up, that will be the best breadth we've seen since the fourth quarter of 2021. Earnings on average are up 12.4% versus the 7.3% consensus expectation. Should that hold up, 12.4% would be the highest growth rate since that same quarter. It bears noting that earnings growth for the Mag 7 is expected to be 21.7% in the current quarter. Growth for the not-so-Mag 493 is expected to still be plenty healthy at 9.7%. Overall, beats have come in at 78% thus far, which is about normal. Now, at the beginning of the season, 7 of the 11 sectors were expected to show year-over-year growth. Of the 4 laggards, 3 are cyclicals: industrials, materials, and energy. The other, a bit of a surprise, is staples. Now, thus far, only energy is living up to its doldrums, down 30% with about half of the sector's firms reporting. Industrials has been a pleasant surprise, with 68% of firms reporting earnings growth is 15% on average, some 20 points better than expected. Top-line growth overall has also been better than expected at 5.6% versus the estimate of 4.7%. 72% of those reporting have shown increases over the prior fourth quarter. Now, a couple of flies in the ointment. Net profit margin development is coming in a bit soft thus far at 12.1% versus an estimate of 12.9%. Nearly half of those reporting have shown declines sequentially. And negative earnings revisions are modestly outnumbering positive ones. So to sum up, large corporate earnings, which underpin just about every asset class and credit, is in solid shape as you might expect when the economy has performed better than expected and above potential. This leaves us in good stead from a credit standpoint as we begin to slow back toward potential. So there you have it, 3 things in credit. 1, tariff time. It's a wild card with risk skewed to the downside, but we believe Trump's experience in 2018 will curb his worst instincts. 2, credit's iPhone moment. Continued growth and innovation in private markets is a welcome development. And 3, earnings checkup. From a credit perspective, it's almost all good. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week. Fly, Eagles, fly.